about next. One more point that should make clear for the balance sheet is asset valuation, and I believe Barbara's mentioned this in some of her talks the last couple of weeks. We do have a problem in how we value assets. Basic accounting manners say to use cost basis, which is the value or the cost of the item minus depreciation plus any improvements can be built into the cost basis. Or if you consider, say, a cow, if you're in a dairy and you raise a calf and then put her into the cow herd, a heifer into the cow herd for milk production, you can calculate a farm production cost and then use that as your cost basis. Market basis is just the current value, market value minus the selling cost. Both of these measurements of assets have different uses. So oftentimes we recommend keeping a cost basis and a market basis, particularly for assets such as land, long-term assets. For current assets, they're identical. There's no difference between the cost basis and the market basis. But for intermediate and long-term assets classes, there can be a difference. And for instance, market basis, if you use market basis for land, that could support a loan application better because it does use current market values for the land and or the equipment. And if the lender was to take a lien against one of those assets, then it does reflect the current market value rather than the cost basis, which cost basis could be in some cases near zero for those assets, or quite a bit different from the current market value. So that being said, keep that in mind as you put together these balance sheets. This is the form of a balance sheet, and you'll notice that assets, well, essentially a balance sheet is a numerical expression of the accounting equation, which says net worth equals assets minus liabilities. Or another way of saying it is that the assets, the total assets of the farm, are divided amongst the liabilities. In other words, the people who own a share of your assets, and your net worth or owner equity is your share of the total assets that you own, is another way of explaining it. The other organizational factor of a balance sheet is the assets. Oh, excuse me. I got the little head there. The assets are listed in decreasing order of liquidity. So what that simply means is current assets are assets that can be turned into cash essentially instantaneously or nearly so without any disruption in the business, in the operation of the business. Intermediate assets, and these are current assets are usually defined as assets that will be turned into cash within 1 year. Intermediate assets are assets usually defined as 1 to 10 years, and these can be, this asset class fits breeding animals, machinery, equipment, vehicles, types of assets that match that kind of lifespan, typically, useful lifespan, 1 to 10 years, and can be turned into cash relatively easily, but by doing so usually disrupts the operation of the business. Fixed assets are usually just farmland, buildings and improvements, fences, and real estate. These are classes of assets generally longer than 10 years, and they cannot be turned into cash very easily. They have usually large selling costs associated with and totally disrupt the business. So that's why they're considered fixed. And then the liability classes match those corresponding asset classes. So you try and have you'll notice these machinery notes are 3 to 6 year notes. They match the class of assets listed under intermediate. And the long-term notes match then the long-term asset class. So, I should also mention that a balance sheet, and you can get these printed balance sheets. They're available online. You can use one from your lender. You can use one through a computer program. But they usually have supporting statements. In other words, under accounts receivable, there will be a supporting schedule where you can list your accounts receivable. Under supplies or inventories of crops, you can list, there will be a supporting schedule where you could list those supplies. Same things under accounts payable. You can list your accounts payable, machinery schedules, livestock, breeding livestock schedules, all would be listed under corresponding schedules. That provides much more information than just the printout of the balance sheet. So some of the uses of a balance sheet or meanings that we can get off the balance sheet. This first refers to the liquidity, and liquidity, I mentioned it earlier, just means the ability to meet current financial obligations but without disrupting the normal business. In other words, an ability to meet cash obligations. Usually these are measured by a couple different ways. One is called the working capital, which is just the difference between current assets and current liabilities. And the second is a current ratio, which is a ratio between current assets and current liabilities. So let's just say your current ratio equal 1.3 is in the example. That means for every $1.30 of assets, there's $1 of current liabilities. If that ratio is too low, it could indicate some cash flow problems, or if something happens and some unexpected costs appear, you just don't have the ability to meet those. If it's too high, it just indicates, if it's say 3 or 4 or 5 or 100, let's use 100. It just shows that you're holding too much cash, and those cash assets could be used to lower. You're not getting any return on them. Usually, those types of returns on cash is quite low, and you could use those to retire some debt or put it to use in your business to have better return than just sitting there for cash purposes. And they can be, holding inventory can result in this also. And I've seen this current ratio expressed incorrectly in several publications lately. So make sure you're using it correctly, because the current ratio, any of these ratios, there's actually 16 ratios that are commonly used, come off the balance sheet, income statement, and cash flow statement. And we're just going to mention a few of them today, but make sure you're using them correctly. And if you record them every year, it gives you an opportunity to compare how you're making progress. They can also be used if you're comparing against a similar business or similar enterprise as your own. Another area you can get off the balance sheet is solvency. And solvency measures basically what happens if what's really going on here. If I cash out the whole business, do I have a solvent business? Just compares the total assets and total liabilities. One common ratio is the debt to asset ratio, which just measure how much liability per dollar of assets. So if you have, say, 0.7, it means there's 70 cents of liability for $1 of total assets. In other words, 70% of the farm assets are owned by lenders. If you're over 1, essentially means you're insolvent because your debt's higher than your total assets. Another ratio is the debt to equity ratio, which measures total liabilities to owner equity. So if it's 1, that means debt and equity are the same, so 50% of the total assets are owned by the bank or lenders, and 50% are owned by the owner. Now we're going to turn to the income statement. Before we do, this diagram shows a similar one as we had earlier. This shows specifically the relationship between the income statement and the balance sheet. And what we need, and Barbara has talked a couple times, again referring to Barbara Leachman's talks, about the importance of having good records and good accounting systems, and she's talked about accrual accounting systems as being the most correct and very useful, and she is 100% right. If all farmers and ranchers could go to accrual accounting systems, we could be a much more responsible and viable sector of the business economy. But the fact is that it's estimates anyway, that 90% of farmers use cash accounting records, cash accounting methods. And whether or not, regardless of the reasons, that's just the case, the way it is. So what we're going to talk about today is a net farm income statement, but one that's accrually adjusted. So it takes information from the beginning balance sheet and the ending balance sheets, and then makes adjustments to the cash accounting records contained in the income statement, which its simplest income statement is a Schedule F. It makes changes to that to give a really good estimate of what actually happened in the net farm income of that farm in that time period that's under examination. This is what the accrual adjustments make, or the adjustments look like. There's two adjustments to cash receipts. One is on inventory values, changes in inventory values. We'll talk about that in just a second. The other one is on accounts receivable. And then there's several adjustments to the expense side. So inventories, those would be inventories of supplies, inventories of crops, and those inventories come right off of the schedules from the balance sheet. You take your beginning inventories and compare those to the ending inventories, and if the ending inventories grew, if those inventories grew, it adds that back into the gross revenue for the year, so that it gives what accrual systems do is they match expenses and incomes with the actual time that they occur. Since cash, I mean, you can be selling inventories from 3 years before if it's a commodity that can be stored or preserved that long. Since that can take place, what this does by adjusting by inventories, it gives us a clearer picture of what actually happened in that year. So if inventories increased, they're added back in to the gross revenues. That difference. If inventories dropped, in other words, you sold out of inventory, that's taken out of the gross revenues, the difference, in order to adjust for the fact that inventories dropped. I hope you can see that. And same thing on the cash disbursement side. Let's just look at accounts payable. If you had started with accounts payable of $100 and you ended with accounts payable of $200, so you ended with a higher accounts payable level, then you've got to adjust your operating expenses to show which accounts payable are due to that year. And these adjustments on accrued expenses, that could be also on prepaid expenses, unused supplies, and you can actually, I guess I put supplies up in the inventory category, but they have it down here in the disbursement category. But anyway, the main thing is that all these adjustments need to be made in order to get a accrually adjusted